Hello, my fellow investors, and welcome back to another earnings report analysis as well as a stock analysis too. Today, guys, let's actually take a look at the company Walgreens Boots Alliance. This one was brought up by Tony Myers. This was 7 days ago. I'm finally getting to it, but he pretty much just said, can you cover WBA mixed earnings recently? And honestly, I didn't even know that they had earnings. I know he said mixed earnings recently, but now that I'm looking at it now, I did not realize that they had earnings. It just completely escaped my mind. So we're going to take a look at the earnings. We're going to analyze them a little bit as well. We're also going to do a stock analysis to see if at the current share price, and of course, taking into account their forward guidance on those earnings, let's see if at the current share price, this is looking like a buy. So with that said, let's get started with this analysis. Alright guys, so we all know pretty much what Walgreens does, right? They're a store that is mainly for pharmaceutical things like healthcare. They issue like basic over-the-counter kind of stuff, and you could get like prescription drugs from like your doctor there as well. And they also just sell like a bunch of other just like random stuff as well. So that's essentially what they do. If you live here in the US, there's pretty much one in every single corner, just like CVS. So that's pretty much what they do. Now, let's actually take a look at over here their latest quarter's earnings. This is a quick snapshot. Announcing date was on the 5th of January. EPS normalized actual came in at $1.16, which is a beat by 2 cents. EPS GAAP actual negative $4.31. That was a miss by, well, $5.19. That's absolutely massive. Revenue, however, $33.38 billion, which was a beat by $412.13 million. So, Tony, when you said mixed earnings recently, boy, you weren't kidding. Oh, dear Lord. So now with that, let's actually take a look at their earnings report. Again, like always, I will have this earnings report link in the description below. It'll be the first link. So if you guys want to read it, please make sure you do, because well, it's pretty long and I'm not going to cover the entire thing here. It'll just take forever. So again, link in the description if you guys want to read it. And I highly encourage, if you guys do want to invest in Walgreens, please read it, because there really is a bunch of information in here that might sway you one way or another, whether or not you may want to invest it. But nonetheless, let's take a look at this. We got first quarter financial highlights. In fact, I will actually make this a little bit bigger. There we go. We got the first quarter financial highlights. First quarter loss per share was $4.31 compared to the earnings per share EPS $4.13 in the year ago quarter, reflecting a $6.5 billion pre-tax charge recognized in the connection with the previous announced opioid litigation settlement frameworks and certain other opioids related matters. I did not know that they were in a litigation process for opioids. That's a little bit concerning, not even going to lie. But nonetheless, it was still a pretty massive loss. Adjusted EPS decreased 30.8% to $1.16, down 29.9% on a constant currency basis against strong growth of 53.1% in the year ago quarter, reflecting higher COVID vaccine volumes, meaning that last year there were a lot more higher COVID vaccine volumes than this year, so they obviously went down. First quarter sales decreased 1.5% year over year to $33.4 billion, up 1.1% on a constant currency basis, including the negative impact from Alliance RX Walgreens of 485 basis points and the positive contributions from the United Healthcare M&A of 280 basis points. Sales growth was 3.2% on a constant currency basis. Invested $3.5 billion in debt and equity to support Village MD's acquisition of Summit Health. So they made an acquisition, guys, and they took on $3.5 billion worth of debt in order to buy this acquisition, which closed January 3rd. So they literally just closed this like 2 days before these earnings report came out. So it's actually really good that they closed this early. So that way we could have actually seen it on the earnings report for this quarter. Accelerated US healthcare segment sales and path to profitability. Sold 19.2 million shares of Amerisource. Wait a minute, isn't this the one I just covered? Wait, what? Oh, I get, like, I literally just covered this stock, Amerisource Birkin, just like a couple days ago. I think it was yesterday. Wow, wow. That was actually kind of neat. That was okay. I don't know if you guys planned it out that way. I highly doubt that you guys planned it out that way, but cool. Awesome. But anyways, they did sell 19.2 million shares of Amerisource Birkin common stock in November and December, with after-tax cash proceeds of $3 billion. Now, looking down over here, we do get to see their fiscal 2023 outlook. Very, very important. We got maintaining full year adjusted EPS guidance of $4.45 to $4.65. A strong core business growth is more than offset by lapping a fiscal year 2022 COVID-19 execution and currency headwinds. Raising full year sales guidance to $133.5 billion to $137.5 billion, reflecting a Summit Health acquisition, refreshed currency rates, and first quarter sales ahead of expectations. U.S. healthcare targets raised with Summit Health announcement on November 7th, including fiscal year 2025 sales goal to $14.5 billion to $16 billion, up from $11 billion to $12 billion previously, and positive adjusted EBITDA expected for the segment by the end of fiscal year 2022. And lastly, increased clarity into the company's long-term growth algorithm, building to low teens adjusted EPS growth in fiscal year 2025 and beyond. So they believe that they have some pretty good outlooks in the future, but currently they not so good, at least when it came to those numbers. Anyways, we got over here the Chief Executive Officer, Rosalind Brewer, pretty much just said WBA delivered a solid start to the fiscal year as we continue to accelerate our transformation to a consumer-centric healthcare company. We're making significant progress in driving our U.S. healthcare segment to scale and profit, including the recent Village MD acquisition of Summit Health, which we just read up there. Our core retail pharmacy businesses in both the United States and the United Kingdom remain resilient in challenging operating environments. Execution across segments reinforces our confidence in achieving full year guidance, and our strategic actions are creating long-term shareholder value. So even the CEO is still pretty, I guess, bullish when it comes to their outlook. I guess this may have just, or at least the way that they see it, this may just been a little bit of a hiccup. But now what I would like to do is compare these numbers to 2021. Now, we do know, obviously, that they did go down, but I still would like to see the numbers. So we got sales from $33.9 billion. Wait, this is so this is in millions. We got sales $33.9 billion 2021 to $33.4 billion in 2022. That's a pretty big decrease. Operating income came in at a loss, going from, positive $1.3 billion 2021 to a negative $6.15 billion. That's a massive loss. Like, that is a ridiculously bad loss. Oh dear Lord. If we actually come down here, we also get to see right over here, stock purchases. They went from negative 154 to 150 million. And when it comes to the cash paid in dividends, they're going from 413 to 415. So they're decreasing the stock purchases, but they are increasing the cash paid in dividends, which to some dividend investors, that may be good. However, guys, again, dividends are not 100% certain. You gotta have the correct payout ratio to that free cash flow in order to maintain that dividend payment. So now with that said, let's actually jump into the calculator. We got the ticker symbol for WBA, market cap of $31.62 billion, a PE of NA. And guys, the reason why this is happening is it's actually not me inputting anything. Like, I'm gonna put in over here, guys, Apple, just so that way you guys can see that it is showing the PE. It's just that for some reason, when it comes to WBA, it's not showing the PE. At least when the trailing 12 months, it is NA. That's a problem, but a company's worth more than just the PE. So we'll take a look at other fundamentals in just 1 second, but just letting you know that the trailing 12 months PE, it is non-existent. So that's a red flag just for starters, which is not really good to see. Share price of $36.66. And looking at the share price on the 1 year, they were down, guys, 32%. And on the year to date, 1.43%. So even year to date, it's only been around 12 days since I'm recording this. They're down almost 1.5%. Okay. Again, it might serve as a buying opportunity, but looking at this 52-week range, we can see $30.39 to $54.72. So not 52-week lows, but fairly close to that 52-week low kind of mark. They do pay out a dividend, even though, in my personal opinion, I do not believe that it's sustainable, and I'll show you guys why in just 1 second. But their dividend yield is just absolutely massive. 5.17%. Annual dividends of $1.92, as I showed you, a payout ratio of 42.46. However, in regards to the free cash flow, it is a little bit more concerning. 5-year CAGR of 4.32 with 30 consecutive years of dividend payment. So they are a dividend aristocrat, and 30 years is nothing to laugh about. That's pretty sustainable. Like, managing that, that's pretty good. Ex-dividend date passed as of November 14th, so probably the next one will be at around like February 14th, so Valentine's Day. Payout date was on the 12th, so again, they'll probably pay out in like March 12th or something around that kind of date, and they pay their dividends quarterly. Now, as I said, this dividend, the payout ratio is not necessarily that reliable, at least in Seeking Alpha. Here's the reason why. Comparing this to the current shares outstanding, guys, they pay out $1.66, I'm gonna round it up, $1.66 billion in dividends every single year. After this is paid, based off of their last year's free cash flow, they're still left with $2.6 billion. Okay, not too shabby, right? Not too shabby. However, as of the last year's free cash flow, they're only left with $509.4 million. So they went from $2.59 billion to $509 million. That payout ratio is 76.47% on the last year's free cash flow, and I'm gonna round it up to 40% on the 5-year average. Their cash flow just completely crashed last year. And it's insane, like 76%, almost 76.5%, guys. That's massive. So usually when this happens, you run the risk of a company actually cutting your dividend, and there goes your cash flow. So please tread very, very carefully if you choose to invest in this company for its dividend, because even though they are able to afford this in the 5-year, as of last year, it's getting up there. It really is getting up there. So now let's go quickly through the fundamentals. We got the net income 5 years ago of $5 billion to 1 year ago of $4.34 billion. That's a decrease of 14%. I gave this a 55. Now, here's my issue when it comes to pretty much all of these profit metrics, honestly, is that sure, you got a hit when it came to COVID. However, when you see it, you can actually see that they were in decline before, right? 4 years ago, they were down from 5 years ago. Now, they came really down during COVID, but then they rebounded really, really nicely. Not as much as 5 years ago, but they did rebound. And in some cases, COVID actually revitalized it, and actually we can see that over here in the free cash flow. 5 years ago of $6.9 billion to 1 year ago of $2.16 billion. That is a decrease of 69%, with an average of $4.25 billion. Now, I gave this grade, guys, a 40%. They're still in decline, but take a look at this. Even before COVID, they went from $6.9 billion to $3.9 billion 4 years ago. And then during COVID, they actually came up when it came to their free cash flow. And they came up a little bit more following COVID the following year. And then 1 year ago, they just crashed to $2.16 billion. So this is very, very mixed overall. In fact, we can even see this once again when it comes to the revenue. Got 5 years ago of $131.5 billion to $132.7 billion. Again, you see a dip from 5 to 4 years ago, and then COVID came. They did a little bit better than 4 years ago. Then it just kept rising and rising and rising. So overall, that is an increase of less than 1% at 0.89%, which on average, I gave this one a 60%. When it comes to the total assets minus total liabilities, we can see that they are in the positive overall. They're currently at $24.7 billion in this difference. Their biggest year was 1 year ago at $30.41 billion, but overall, it's just kind of flat across the board. And, I gave it a 60% because of the fact that at least they've been positive. Average total assets is $83.8 billion. Average liabilities is $58.9 billion. And doing this difference, we get almost $25 billion in the positive. When it comes to the cash flow minus the liabilities, as of 1 year ago, they're at negative $57.55 billion. Now, I gave it a 75%. Mainly because, well, they did go up slightly when it came to 3 years ago to 2 years ago, but then they came down again. And in fact, you even see this from 5 to 4 to 3 years ago, they were consistently decreasing. So you know what? I'm actually going to change this right now because I did not go through that in my head when I first saw this. So I'm actually going to change this to a 45% over here because, they only had one time where they brought it back up. Average cash flow minus the average total liabilities, we get negative $49.31 billion. Now, when it comes to the shares outstanding, this one's actually looking amazing. Consistent decrease within the past 5 years, and a pretty decent decrease at that too. 5 years ago of 954.1 million shares to today of 862.3 million shares, decrease of almost 9.5%. And from the previous year to the current year, that is another decrease of 0.27%. And in fact, not a single year did they issue shares. Even during COVID, even after COVID, they did not issue shares. So that's why I'm giving it a 100%. And when it comes to the cash and equivalents, they currently hold $2.35 billion with an average of $1.1 billion. With the overall grades now, we gave net income 55%, free cash flow 40%, revenue 60%, assets minus liabilities 60%, cash flow minus liabilities 45%, and the shares outstanding of 100%, for an overall grade of 59%. Now, my issue with this is, well, it's honestly mainly the net income and the free cash flow. Honestly, if they were to fix this, this would easily be like above 70%. Because if they fix the free cash flow, the cash flow minus the liabilities will also get better too, right? So I think that if they would just fix just these two profit metrics, the net income and the free cash flow, this would easily be 70%. But for now, for me personally, it's a 59% kind of company. Now, whether you invest in it or not at the current share price, that's really up to you. But I'm going to do a couple of assumptions here to see if I would like to buy it. We're going to use revenue growth, predicted share buyback, and a required rate of return of flat 10%. And with a revenue growth of 1, 2, and 3%, and a predicted share buyback of 2, 3, and 4% for the low, medium, high assumptions, we get the target share prices not adjusting for debt of $52.06 to $57.01. Adjusting for debt, this comes down by a lot, $16.72 to essentially $21 for the highest assumption, with a margin of safety of 5, 10, 50%. The lowest assumption, highest margin of safety of 15%. We get the price tag of $14.21, and for the highest assumption, for the lowest margin of safety of 5%, we get almost $20. So with the current share price of $36.66, you can clearly see that target share price is not adjusting for debt. It's looking like a buy, like it really is. Adjusting for debt though, it's not really a buy right now. And in fact, remember that 52-week range? The 52-week range, the lowest point was $30. So even then, it was still not a buy. We were still off by like, what, $9 or so, right? But then again, guys, that's just my personal opinion when it comes to this. Every investment is the present value of all future cash flow, and this is not financial advice. So if you guys still like Walgreens, I'm not saying there isn't potential here. There's plenty of potential. Trust me, there's plenty of potential. I personally am one of those people that do not believe that we're going to get like drug prescription pills on like through Amazon. I just do not. I refuse to believe that. So I don't think that they're going anywhere, and they do have a lot of prospects. It's just that, you know, based off of their fundamentals, I would like to see better net income and better free cash flow as it currently stands. But if you guys still want to invest in this company, I highly suggest you have these calculators. They're available for free. Anybody can have them, guys. Look at the description below, all calculators video. Make your own assumptions. You guys can even put your own grades and see where you land. You guys can change this to required rate of return. You know, you can put like lower than 10%, higher than 10%, whatever. You can change these margin of safety as well. I also have the book valuation calculator, which uses book value, and I also have a reevaluation calculator for REIT companies and a dividend tracking sheet, because this company does pay the dividend. So if you guys would like to track it without having to log into your brokerage account every single time, because I know it can be a pain, you know, and you also risk some like securities issues as well, you know, I also have that as well. So please have this all for free, guys. All I'm asking for in return is just like, subscribe, comment. Really does help here with the algorithm on YouTube. Thank you so much for everybody who has subscribed so far. Thank you so much for everybody who has, you know, just helped me through my endeavors through this YouTube thing. I never thought I would get to this point, and you know, I have a lot of prospects to go. So thank you all so much for joining me in this journey. So now let's actually take a look at this dividend, because the yield is pretty big, right? Massive, 5%, huge. $1.92, guys, putting in $5,725. This nets you an annual dividends of almost $300, quarterly of almost $75, and a monthly of $25. Again, this is looking juicy. I'm not saying it's not, but that payout ratio, 76%. They can still afford it. It's not above 100, but it's getting there. It really is getting there. My threshold is like 60%. At 74, ooh, that's kind of risking it a little bit. So again, it really is up to you. With a 59% for me, yeah, this dividend would be a lot more impressive if this was like 50%. Like if this was 50%, I'd be like, okay, that's a good. I don't even care if it's a 59% company at that point. That dividend is like, okay, I'll risk it. I'll risk it at that point. But as it currently stands, it's nah. It's just not really that interesting for me at the current moment. So all in all, when it comes to Walgreens, again, I do think that they have potential. However, they do have hurdles currently, especially with the economic environment, higher interest rates, etc., etc., etc. So yeah, they definitely do need to pick it up, especially on that net income and free cash flow. But I don't think that they're going anywhere. And if you guys would like to invest in this company, please do your own due diligence, because again, this is not financial advice. I will have the earnings report link in the description below so you guys can read it. And again, all the calculators are free. That pretty much is it for this video, everybody. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my YouTube sites. Link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video, as well as earnings report, which, by the way, we're going to get a lot tomorrow, because tomorrow, Friday the 13th. Yeah, Friday the 13th. We're getting the banks. Oh, this is going to be real fun.